Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The markets have largely been quiet this week ahead of the USDA report. We can see where the market has been sideways for quite some time, with our key resistance sitting at the key 929 level previously mentioned. We also have our timing angle where the market has found very good support over the last several months. And now we can see where the market has found key potential support sitting right at this level. We anticipate that soybean may finally break this level, especially as we can see on the chart that the market has moved from being in an overbought position and is starting to move downward. Upon breaking this level, we would then be looking for a potential retest of previous lows, with the chance of the market reaching the 883 key support level that we've long been mentioning as our make or break level. For several months now, the range-bound action has been bound overhead by our 360-degree mark at 928 3/4, and it has found reasonable support near our 90-degree level of 898, which also happens to coincide with our point of control level of 896.5. Soybean will need to clear one of these key support and resistance levels to find some significant follow-through, but a retest of previous lows could very well be underway for the soybean market. The May contract finds itself in a similar position where we have key resistance overhead sitting at 941.5, and the market looks poised to break below our timing angle, with the potential of the May contract making its way down to about 896 if the market were to fail below our timing angle. The 360-degree mark for the May contract sits at 926, and for the May contract, this has been a pivotal level where the market has traded on either side of this key 360-degree level, reaching support and resistance about equidistant on either side. The market needs to clear its way from the 360-degree mark and clear either overhead resistance or downside support, which currently sits right at its point of control level of 906.5. In a similar manner, March corn futures has also been range-bound over the last several months, finding resistance at 382 and actually finding support near the 375 level. Previous support was at 368 1/4, but the market has now made its way up above that level, and the trading range has been very tight over the last several weeks. We can also see where volatility-based bands have been narrowing for this market, and the market has simply been trading in a much more narrow range than it had in the past. Once our volatility bands are able to come together and the market's able to break through on either side of its volatility range, we would then anticipate some continued action in either direction, but we need to see some clarity in terms of the direction of the market, and we believe that the upcoming USDA report will give us more vision as to the direction potentially for the corn complex. The March contract has been drawn to its point of control level of 379 1/4, and the market's really going to need to be able to pull away from its point of control level before we can see some true activity occurring in the corn complex. We can see much of the same for the May contract, where 388.5 had been key resistance, and that 388.5 number also happened to be our point of control level for the May corn contract. We can see where its volatility bands have also been narrowing, and the market has responded in kind and trading in a very tight, narrow band as well. Upon touching one of these volatility bands, that would in turn be a possible signal where the market can in turn start to break out from its tight volatility range. But until then, we'll remain tight, and we'll also be monitoring the way in which the market responds to the upcoming USDA report. The March wheat contract continues to hang on. After getting very close to our 538 target, the market then turned back down, only to find a bit of recovery going into the report today on Friday. We're also noticing where the market continues to make a series of small higher lows, suggesting that the market still has a potential chance of making its way higher. The last 2 or 3 lows that it made were very close to simply being a triple bottom, and so this market's capacity to close above this key 518 number that we've long been talking about is very important for this March contract. If the market's able to close this week above 518, we still believe that there's a chance for the market to make one final run up to that 538 number that we've previously discussed. If it's not able to close above 518, then we anticipate a retest of previous lows coming in at about 503 and possibly lower. The trading range for the March contract has found resistance at the 531.5 number, which is our 360-degree mark, and below it found support at 508.5, which is the 90-degree mark. Right in between, we can see where the point of control level of 522 has been key, where the market has oscillated, and it's going to need to clear either the top side of 531.5 or the bottom of 508.5 before it's really able to move ahead. As would be expected, the May contract is moving in a similar fashion, and the 524 number is going to be the key area for this market to close above this week if it is to make a run at previous highs sitting at 543. If the market were to close below this 524 number, we would then be looking for the May contract to potentially retest previous lows at 509 3/4, with the potential of making it even down a little bit lower, down to about 502. We will close out today with a look at the crude oil complex. And as we can see, the market made its way up, right up against our timing angle. And this is exactly where the market found resistance before turning back down. It was not able to make it quite up to the 58 target that we discussed previously. And now with the market turning back down and retesting the key 53.42 number, if we were to close below this number to close the week, we do anticipate that a correction can now occur where the market, after having made a very nice run up to about 57 or 56.5, would make a correction. And if it were to find support somewhere in the neighborhood of 48 to 50, we believe that the next leg up for this contract could very well come up and reach somewhere in the neighborhood of 62 to 63. So it's going to be very important to see the way in which this correction occurs if this market continues lower, especially if it were to close below this 52.40 number that we previously discussed. We can also see where our 1x1 angle has operated as very key resistance for quite some time. And then we find a time factor coming in where the market reached up against our time factor, which coincides with this now downside move that we're seeing. We have a 2x1 downside angle that's occurring, and we have potential support coming in at about 52. Getting below that 52 number would then clear the way for the market to potentially find support near that 48 to 50 number we just discussed. And then from there, we'd be looking for potential advance. Thank you so much for joining us for our regular market update. Look forward to touching base with you again next time.